Hello and welcome, everyone. I want to thank you for taking a few minutes out of your day to watch this presentation. My name is Bruce Cline. I'm with Gulf Coast Home Loans. Most folks around here, a lot of them call me Bayside Bruce. You can call me Bruce. You can call me Hey You. But I'm an independent mortgage broker based right here on the Bolivar Peninsula, and I work with buyers and sellers and real estate agents all over Galveston County. And today I want to walk you through one strategy that's often overlooked, and I'm seeing it change how listings are moving in this market. If you have a listing that's been sitting and it's on its third or fourth price reduction, we all know how that's been in this market, and you're having barely any new showings, this is for you. So if you're a seller and your home has not been getting many showings, but you know you have it priced correctly, or if you're a real estate agent, same thing. Maybe you've lowered that price a few times. This presentation is for you, and I want to show you what it's all about. So let's dive in. So let's start with the pattern I'm seeing. Okay. I'm seeing this across the peninsula and in Galveston right now, and I want to break it into four pieces. First, pricing strategy. Um, if you've done your due diligence, you're working with the seller, and you're doing the comps properly, and you're looking at the pricing, how homes are moving, and you know you have it priced according to the comps. Um, and a lot of these have already gone through multiple price reductions. So that's the first part of it. The second part is the presentation. Um, these are not neglected listings. They're professionally staged, many of them, and marketed, and they do attract initial attention. And third is traffic versus conversion. That's really the heart of the problem. High listing traffic is not translating into offers, and some of you are not having much traffic at all. People are looking, they're just not writing offers. So that brings us to the core question. Is the price truly the problem, or is it the monthly payment? That monthly payment calculation that's discouraging the buyers once they sit down and run the numbers and see the principal and interest, and then the taxes and insurance on top of that. All those numbers combined, usually a lot of times the buyer gets sticker shock when they see that, especially if they're moving from a home that they've got a 3% interest rate on. And, it's a property they're buying as a second home or investment property, and that the rates are for second home around 7%. If it's a primary, it's maybe in the low to mid sixes. But for investment property and second homes, that rate's a bit higher. And so when they see that mortgage payment combined with taxes and insurance, it's more than they've expected. And I think that's what's stalling the market. So that's why I wanted to share this with you. So here's what's actually happening. This pie chart breaks down a typical monthly payment here on the coast. Okay, principal and interest is 64% of the payment. Insurance premiums are 21%, maybe more where you are, more or less where you are. And property taxes are about 14% of that payment. And notice that insurance actually outweighs property taxes, okay, which surprises people coming from inland markets. On the coast, a full insurance picture usually means standard homeowners coverage plus windstorm and flood insurance. And all three of those, that adds up fast. So stack all that together, and the payment on a home can feel out of reach, even when the price on the sign looks reasonable. So let's do the real comparison. This is the core idea behind everything I'm going to show you today. Buyers do not only shop the price, they shop the payment. Maybe they see the price and they think it's affordable, but they're often surprised to learn that when that monthly payment, what it looks like once the insurance and property taxes are included. So a price reduction lowers the number on the sign and reduces the seller's net, what they're going to get, but it has only a marginal impact on the monthly payment. And it can raise questions in a buyer's mind about value. So a rate buy down works differently. Okay. It directly lowers the payment. It delivers higher dollar for dollar value, and it gives you a strong marketing hook, all while keeping the seller's price and equity intact. And that's important. And you're going to see what I'm talking about in just a minute. So there are two main ways to do this, and it's worth knowing both so you can match the right one with the right buyer. Okay, the first is a permanent buy down. Seller credits reduce the interest rate for the entire duration of the loan term. This is ideal for primary residence and long-term property holds where stability is the priority. The second is a 2-1 temporary buy down. Now there are three 2-1 buy downs. There are 1-0 buy downs. I just want to talk about the 2-1 to give you an idea of what that looks like. Here, the seller will fund an escrow account that subsidizes the payment, resulting in a 2% rate reduction in the first year and a 1% rate reduction in year 2. Now, this one's ideal for buyers who expect future income growth or who are planning to refinance when rates drop. So if rates drop before that 2-year period, when you hit that 3rd year and it goes to the note rate, if rates drop, you're going to refinance that into a 30-year term at a lower rate. And it's going to save a lot of money in those first 2 years. And I'm going to show you. Check it out. So let's say on this example here, $520,000 purchase price, loan amount of $420,000. So we got 20% down. Loan amount's $420,000. It's a second home. I'll price this out on July 21st of this year, which if you're watching this later, this is July 21st, 2026. So in the first box here, you see the price reduction. The rate stays at 7.25. If it's a second home investment property, that's kind of where the rates are. And that monthly payment for principal and interest is $27.84. So if you reduce that price, okay, rate stays at 7.25, you've knocked down that price by it's $15,000 basically. If you have a $15,000 price reduction on this home, it knocks the price down to $27.84, saving you at around $81 a month. Look over at the second box. On a permanent rate buy down, you can knock that rate down to 6.25 using the same amount of funds, and it's going to give you $279 a month saving over the life of the loan, as long as they keep that, that particular loan program. If they don't refinance. So $279 versus $81. So you've got a $3,350 savings per year. Okay. And this is using the same $15,000 rounded number. If they reduce the price or if they want to use a permanent rate buy down, just showing you how it's more attractive to lower the rate than it is to lower the payment. Now imagine this home is a $750,000 price home. That payment reduction is double that. Okay. So anyway, let's move on to the next. So what I'm trying to get at is I want to make this concrete for a seller actually facing this decision today. Say a seller is considering a straight $15,000 price reduction on a $520,000 listing. Cut the price, it drops to $505. The seller nets $15,000 less on the sale. The buyer's payment falls to $27.82 a month. All right. And the savings is only $83 a month. Total cost to the seller, the full $15,000. So their net proceeds are going to be $15,000 less. Now here is the alternative. Offer a 2-1 rate buy down instead. And this is different from that permanent rate down. This is the 2-1. And the list price never moves. Okay, so it stays right at $520. In year 1, the rate drops to 5.25%. The payment's $23.19. saving the buyer $546 a month. In year 2, the rate is 6.25, payments $25.86. That saves the buyer $279 a month. And then in year 3, it goes to the note rate, the normal monthly payment of $28.65. So in this scenario, you can see that adds up to 2 years of relief of $6,500. Is that right? $6,551 in year 1. Save $6,551 in year 1 and $3,349 in year 2. Comes to a total of $9,900 savings. Now that's the same amount that the seller is going to contribute. They're going to contribute that $9,900 that goes in escrow, because when that payment's being made on year 1 at 5.25%, the money in escrow is still going over. It's just not coming out of the buyer's pocket, right? It's coming out of that escrow of that $9,900 that got deposited at closing. So you can see how this has a huge impact. Imagine putting this on your flyer, okay, that you can show, that you have in your showings. You advertise, you put on social media, you talk about, hey, get this home for the first year at 5.25 and the second year at 6.25. Ask me how. And then you have the conversation. So if you compare the two, the price cut costs the seller the full $15,000. The 2-1 buy down costs $9,900, a savings of $5,100 for the seller, while the buyer gets 6.6 times more relief in year 1 than the price cut would have delivered. And the list price never drops a dollar. Okay, so you don't have that value question. Why are they dropping it? They dropped the price. There's something wrong with it. You don't have that. You're just offering to make it more affordable. That's why I'm talking about what I'm talking about here. We're going to do an affordability analysis for your home, for your seller's home. And why does this win more showings? It translates into more showings for 3 reasons. A larger qualified buyer pool, because reducing the monthly payment removes a financial barrier for borrowers who are close but not quite qualifying at today's payment. So that lower rate helps to qualify. Now, on a 2-1 buy down, they're going to be qualifying on that initial note rate. So if it's 7.25, they have to qualify that, even though it's going to save them hundreds in year 1 and year 2. They have to qualify that note rate. Permanent rate buy down, on the other hand, could lower that payment just enough. If they're on that bubble of qualifying, it could lower it and they're able to buy the home. It gives you sharper marketing. A specific rate or payment figure gives you an eye-catching headline that stands out in a crowded market. Now you have to follow, the guidelines. If you're going to be advertising on rates, you got to advertise APR, and I can help you with all of that. You want to get with your marketing team and say, hey, this lender is offering this rate. I just want to make sure I market this to meet compliance, so you're doing it correctly. And your marketing team can help you with that. If not, I'll be happy to. And this also protects your seller's value. If you've got other homes in the area for sale, the last thing you want to do is lower your price $50,000, and then the house you've got 2 blocks over, you just affected the value of that home, right? So you can protect the valuation of these properties, and it doesn't give the appearance to buyers that, oh, why are they lowering the price? There must be something wrong with it. So then they go, yeah, it's been on the market for 8 months and they've lowered the price 3 times. There's got to be something wrong with it. I'm not going to go look at it. So consider this even before. If you know you have the price of the home appropriate, if you know that number is appropriate, you've done the comps, you've done all your due diligence, you know it's priced right, then it's probably not the price that's keeping it from selling. It's something else. That could be curb appeal. It could be in the neighborhood. Who knows? But I know that I'm seeing this personally in my market, where I'm telling buyers, hey, go in there, lowball the price right now. If it's been on the market for some time, lowball the price and tell them you want to pay for a rate buy down. I can tell you how much it will cost them. That's the first question. Well, what's it going to cost? I'll show you the numbers. If it's going to be $15,000, great. I'm seeing sellers go, yes, let's do it. If that'll get this home sold, absolutely. So it's working. And if you hadn't thought about it and you're not sharing this with your sellers, you're doing them a disservice. You need to be sharing this strategy with your sellers. So this is really important because a large share of our buyers here on the coast in Bolivar and Galveston, they're purchasing second homes and investment property. And for them, this math is even more direct. It's a faster financial impact. You get results now, okay? Instead of waiting on long-term market appreciation to build equity, okay, if you have that lower rate, because you're getting a higher return on your investment. Reduce borrowing costs, boost profits immediately while easing the buyer into the new payment. And it is immediate cash flow improvement. Lowering the monthly debt service increases net operating income starting on day one. So if they're looking at their comps, they're going to buy this as an Airbnb, for example. If that payment is $400 or $500 less a month, that's profit, right? Now it becomes more attractive to that potential investor. So this is why I'm offering this affordability analysis. I can put one of these together for you if you're a realtor. If you're a seller and you want potential buyers to see this, I'll put it together for you. You just need to reach out to me. It's why I built this for sellers and realtors here in our market, the affordability analysis. Look, it's a free, no obligation custom report with a detailed breakdown tailored to your specific property and local market conditions. I'm going to give you a side-by-side payment impact comparison so you can visualize how different price points shift the monthly mortgage obligation for prospective buyers. It's data-backed insights. All right, data-backed insights for listing discussions. So you can lead productive conversations during pricing strategy reviews with objective evidence instead of guesswork. So if another price reduction is on the table for one of your listings, request this analysis first. See the numbers before you decide. Learn about this. If you're a real estate agent, learn about this. It's not complicated. I can walk you through it, but this should be part of your listing presentation. You can say, look how many homes have been on the market for 6 months or longer. There's a bunch. Why is that? Well, Mr. and Mrs. Seller, we've got your home priced appropriately. However, we may not get a lot of traffic. What's the first thing we do as realtors when we don't get a lot of traffic in the first month? We start having that discussion to lower the price. But you did all your homework. You know it's priced right. You don't really want to lower the price. Maybe that's not it. Try this. Give it a try. I'm telling you, when they see a more affordable monthly payment, it makes a big difference. So here's how to request your affordability analysis. It's simple. And this is how it works in practice, whether you're a seller or a realtor watching this today. If you're a seller, don't guess on price adjustments. Ask your agent to request the affordability analysis before cutting your listing price so you can use data-driven insights that align your price with current buyer demand. If you're a realtor, this is a way to provide expert value in your seller updates. So if you just send me the property address and the current price, I will get back to you with a custom comparison report similar to the one I showed you. And it's ready to bring straight into your client presentation. Hey, Mr. and Mrs. Seller, I know we've had a price decrease. I really think we're priced appropriately. I have an idea. I have a strategy that we can use and we can present to potential sellers. And when they see that option of a lower rate, seller paid rate buy down incentive. Lower your payment by whatever. I can show you how much it is, $300 to $500 or whatever. It depends on that price point. But it's very effective. Just imagine if they're coming in and you have a flyer on that island, the kitchen island, that says, hey, your payment here would be this amount, but by using the seller paid contribution to buy down the rate, here's your payment. And if it's $400 or $500 less a month, what would you do? Just think about it. Now you're like, wait a minute, I thought we were going to have to pay a lot more for this. So just really request the affordability analysis. Okay. Again, thank you for taking the time to watch this. I just want to help you take the next price conversation off the price alone. So, let's show them their options other than discounting the price. We've done it. We've seen it over and over and over again. I am seeing this work in my market. Okay. And everybody's happy. The buyers are thrilled. They're like, wait, we can do that? We can ask for that? Heck yeah. It's a negotiation. You go in there and say, hey, I'm interested in buying your home. Here's our offer price. Oh, and by the way, we want a reduced rate. And we've talked to our lender. Here's how much it will cost. It's going to cost you X amount, and it's going to lower your rate. It's going to lower your payment. Look, if they were considering lowering their price another $30, $40, $50,000, buying the rate down saves them money. They get more, equity when they sell the home because they didn't have to lower it 40, 50,000. They just had to maybe pay 20,000 at closing to buy that rate down, either permanently or on a 2-1 temporary rate buy down. So look, this is important because the conversation is not just about the purchase price alone. Okay. You put real numbers next to it. Here's my number. You can reach me directly at 214-729-2947. Here's my email. And if you'd like to have a consultation, you can schedule online at consultwithbruce.com. Best way to reach me, honestly, is a text message. A lot of times I might be working on a loan file and I can't pick up my phone. I'll hear that I got a text message. I might see, hey, give me a call to talk about this affordability analysis. And I'll know that when I get a moment, when I slow down, I can reach out to you and get that done for you. Thanks for watching. I hope to talk to you soon. Take care.